Is it a psychologically important mark, or does it hold more? Well, for those who do believe that it's an important mark, 10-year yield in the U.S. came in within a basis point of that. Overnight, they closed marginally lower, though. What's driven up yields this time around, and are the higher yields leading to strength in the dollar, which in turn is putting pressure on emerging market currencies? Yes, it's all linked. Let's discuss all that and more with Priya Misra, Head of Global Rate Strategy at TD Securities. Priya, very good morning to you from our end. Thanks so much for taking our call. Priya, first word, do you believe that it's largely been the commodity price rises which have pushed yields up close to 3%? And how important is that 3% mark to you? We've had conflicting views on whether it's just psychologically important or more than that.
Hi, thanks for having me. So I think there's certainly been an inflation component. So commodity prices have certainly fueled this sell-off in bond yields. But I would say it's more than just commodities, because we have seen real rates rise as well. And that, in my mind, is ultimately what's damaging about the 3% level. I mean, 3% technically is no magic level. I think it's just and effectively a psychological level. I think we haven't been here in a while. What could be the issue will be if real rates rise significantly. So I think if 10-year real rates get closer to that 1% level, where we're a little bit below 80 basis points right now, I think another 20 basis points higher than that, I think you could be at levels which the U.S. economy really cannot handle real rates that high. The mortgage market, the consumer sector, I would say the government sector, all significantly in debt. I think real rate increases become a problem. So you could see at least risk assets, so both credit spreads as well as equities begin to struggle, I think, if you get further increase in real rates. If it's all led by inflation, it's less of a problem, because, if people are earning more, they can pay more for it as well. I think the problem has been this rise in rates. Part of it has been inflation. Part of it has been sort of a repricing of I would say term premiums. So the fact that the deficit is rising, that's actually increasing pressure on rates. And you're seeing this, across the rates market. That's why the 5-year sector really has been getting hit. So it's more than just inflation. I would say it's supply fears. We have, just to give you numbers, we have in 2019, we're going to expect twice the amount of net supply of treasuries than we had in 2017. So the fact that the deficit is ballooning, I think, is creating fears here. So higher interest rates, I think, for now, the market's been somewhat able to handle it. I do worry about this real rate increase. And, ultimately, I think that can hurt the economy, that can slow the Fed down. The Fed's been extremely quiet so far. But I think any further increase in real rates, the Fed will actually come back into action.
Priya, apart from fiscal fears, is there also, on the backdrop, the issue that QE unwinding is progressing through the course of this year?
Absolutely. That's a great point, because if you had QE, sort of global QE remaining on par, then I think you could have had all the supply being taken down by the rest of the world. What's happening is the ECB is probably ending QE later this year. The BOJ might be changing the yield curve control. The Fed, we know, is on runoff mode. So now when you have all the supply and you have global rates rising, and I think the ECB meeting later this week could be pretty key on that front, if they signal that QE is actually ending by year end, and global interest rates are rising, I think that's when this price creating level for treasuries rises, in the sense that, you don't obviously have all the flows then coming back into the U.S. because global rates are rising. So I think the global QE unwind is absolutely critical for, demand flows into treasuries. This was probably the worst time for us to have that much treasury supply coming in, but, we do have that at the same time that the global unwind is happening of QE. So I think that makes it's sort of a double whammy. You have all the supply, and it's not clear that the demand is there at the same level, which is why interest rates have been rising. The question is, at what point does the economy start reacting to it?
Priya, also, at this stage at least, where the yield differential between the US and, say, Germany, Japan, even UK is widening, is that the cause of the dollar strength that we've seen in recent days?
I think so, yes. The dollar has been sort of underperforming, because I think on a global basis it seemed very clear that the U.S. was not was sort of not outperforming for the last year. I think what's happened in the first quarter is U.S. growth actually remains pretty robust, which is partly why inflation expectations have risen, partly why the Fed seems to be probably on track to hike 2 to 3 times this year. But what we've actually seen is global growth sort of peter out a little bit. I mean, there's clearly trade war fears, but if you look at European growth, it's actually decelerated a little bit, which is why you've seen this widening of the spread between, say, U.S. as well as Germany. I think that's what's fueled the dollar rally. We're not convinced the dollar can, even if U.S. interest rates continue to rise, we actually think that this is a global repricing and, bond yields will actually move higher. So our view is that spread between U.S. and Germany will compress, even though at higher rate level, and that's actually going to prevent the dollar from continuing to strengthen too much. But the key assumption there is that European growth, the weakness that we've seen in the first quarter was weather-related, was not the start of something more negative, which is why the ECB can actually continue to end QE later this year. But yeah, I think absolutely it's that spread, which is why the dollar has strengthened. But, the world actually, I would argue, doesn't need a strong dollar. So I think if the dollar continues to strengthen, I think you have a lot more risk underperformance, which can actually then become self-limiting. What can let all this rise would be actually if global growth remains solid, I think then the dollar doesn't, strengthen that much more, and that allows rates to rise some more then.
From an emerging market perspective, Priya, and a flows perspective, I think would the more damaging situation be that U.S. yields are, close to 3% or maybe above that mark and the dollar is strengthening? Would that sort of be a worst case scenario in some ways for emerging markets?
Yeah, I would argue yes, because, you then have the whole commodity pressure, EM pressure. I think you get the outflow risk. And at the same time, we have the outflow risk potentially for U.S. fixed income, because a lot of the indices are going to start showing, they're already showing slightly negative returns for the year. So, and the big difference between, I would say, a few years ago and now is, cash actually in the U.S. yields a decent level. I mean, we haven't seen, 1.5% cash yields. So you can actually see the safe haven bid not going into treasuries, but actually going into the front end. So essentially outflows from a lot of risk assets into, say, money market funds or bank deposits. That, so there is an alternative now, higher yielding alternative for where these flows can go in if it seems as if, risk is coming under pressure. So, yeah, I would say stronger dollar and higher rates is what, if you look at the U.S. economy, that even though it's somewhat of a closed economy, I think S&P will come under pressure. And then it can become somewhat self-reinforcing until the economy shows signs of some slowdown and the Fed responds. But, in between, it could be a little painful, that, the scenario you laid out.
Priya, I have one more question. I'm not sure how closely you track, flows into emerging markets, particularly bond flows. Now, oil prices are rising, so we've seen domestic rates in India as well rise. Now, one could argue that higher rates should, probably, induce buyers to come in. We've also had an increase in foreign investment limit. But the problem is that, macro conditions are also worsening. Do you think in the current scenario, there would be limited interest from foreign investors to come into a slightly higher risk emerging market like India?
Yeah, I think if the dollar is strengthening, it becomes a little bit of an issue. I think it's not obvious that the currency is working in your favor. So I think that's where the broader dollar strength becomes important. Certainly on the trade front, I think there seems to be a lot less negative news now. So there may be some comfort on that front. But I think the dollar needs to stabilize here. And also I would argue, I think fears around real interest rate rises. The reason why EM has been so well supported really for the last many years has been that the EM complex was providing the highest real rates. And so therefore, that was a very attractive point for money to go. If you're finding U.S. real rates rising, either because of the deficit or because of growth, you suddenly have an alternative without taking that FX risk. So I do worry a little bit about flows into EM if U.S. real rates continue to rise. Now, I'm a little skeptical how much the U.S. economy can handle real rates, but, by the time the economy actually shows signs of any reaction, you could have a lot of flows moving away from EM because real rates are rising. So I think real rates end up being, the ultimate, and the currency, will be driving these EM flows going forward.